In this video, we'll be looking at three things: definition of taxes, the types of taxes, and how the taxes are reflected on a diagram. First thing, definition of taxes. It refers to the involuntary payment of goods and services to the government by household or firms for which they do not receive any goods and service in return. So what is the reason for the government to levy tax? One of the reasons, as we know, is to raise tax revenue, because tax is a major source of funding for the government operations. For example, to fund a teacher who is standing in front of you during a class when your school is a government school. Or, for example, to build a new road. Another reason for imposing tax is to promote certain economic and social goals. For example, to discourage consumption of cigarettes or alcoholic products. So, taxes may be indirect or direct. Direct tax are actually tax on income. It is paid by the household or firms directly to the government. So, some of our examples are the personal income tax or the corporate tax, whereby the corporate will pay a certain amount of money based on their profits made to the government. Indirect tax are taxes on expenditure. It is paid by the household or firms to the government when they are paying for the product itself. So it is indirect payment through a higher price of the products. So for example, the goods and service tax. So some food for thought. So you may want to go and research what is the personal income tax, corporate tax, and the GST tax rate in Singapore. I will go through this in the lesson to have a better research. So therefore, please go and find out yourself. Okay, tax can be imposed as a specific tax or ad valorem tax. Goods and services are taxed in a fixed amount per unit. This is referring to the specific tax. It could be a $5 per unit. So therefore, it is tax per unit of the good is same regardless of the price of the products. Later I'll show this how this can be reflected on the diagram. Next, ad valorem tax. It is taxed on a certain percentage based on the value of the products. So for example, a 10%, which means to say that the higher the price of the goods, the higher will be the tax per unit. So here, let us look at how this can be reflected on the diagram. For a specific and indirect tax. Indirect tax is payment indirectly by the supplier of the goods. So therefore, it will affect the willingness and ability for the supplier to supply the products in the market. And therefore, indirect tax will be reflected by the shift of the supply curve. So government imposes a $3 specific tax, which means to say that at every unit of the products that is being produced, the willingness and ability for the producer to produce will shift upwards by a fixed amount of $3 in this case. So at the 10th unit, right, it is initially the willingness and ability for the producer to produce is at $5. So it will shift up to $8. And the next one is at $10 for this case. Therefore, the supply curve will shift up by the full amount of the tax imposed, which means to say that the vertical distance over here is the tax per unit tax. So as we learned in the previous topic, when the non-price determinants of the supply curve will shift the supply left or rightwards. However, for the case of taxation, the supply curve will shift upwards by the amount of tax imposed. How about ad valorem tax? When the government imposes a 10% tax, it refers to, for example, at the 10th unit, the willingness and ability for the producer to produce is at $20. So a 10% of $20, it will be $22, a $2 difference. Likewise, for this case, it is initially at the $40 for the producer who are willing and able to produce. A 10% will be $44, a difference of $4. And therefore, you can see that by imposing an ad valorem tax, the supply curve shifts up, but in a skewed manner. So this is how you illustrate the two different types of tax, ad valorem tax and specific tax, differently on a diagram. In the next video, we'll cover the effects of taxation. Thank you.